Hola, amigos. Happy Cinco de Mayo. So, in case you didn't follow the market, and if you ever wonder what it did during a particular day and you watch my videos, just look at the color of my shirt. Lots of red, bloody red. Now, today we're going to try something different. And since the channel is now monetized, which is awesome, uh, I'm going to delve into a lot more content. I would say I've probably only delved into maybe 25 to 30% of the playbook. So I'm doing a completely new topic today, life insurance. And those of you that follow me really close, you may remember a couple months back, I had this really lengthy spreadsheet with multiple tabs. Well, here it is again, making a resurfacing today because I have content for probably 10 different videos in there. And some of the stuff I wasn't quite comfortable sharing yet, but today I'm going to delve into what's called a VUL life insurance policy, variable universal life. And there's different ways to look at this. So a lot of folks look at life insurance as a necessity, or at least something that's important, but rarely does it looked at as an investment. And in my opinion, I think it should be. And I'll tell you why. So there's different types of life insurance. There's whole life, variable universal life, term life insurance, which is probably the most popular. But you can use it also as another way to fund a tax-free, tax-advantaged retirement in a sense, because it absolutely is an investment. And I'm going to show you basically take a policy with a death benefit of 500,000. How to fund a $500,000 policy with $250 per month payments. So we're going to take this as an example, and these are real numbers for the most part. I actually have one myself, and those of you that follow me really close, you may recall I mentioned that I worked in the industry for financial advisors in the past. So at the company I worked for, I got sold one of these things, and I'm not the biggest fan of it, and I'm going to break that down and tell you why. So I've had this thing since July 2016, actually, because typically the younger you are, the cheaper insurance is. But policies like these pay the person that sold it to you a big fat commission up front. And that's where a lot of your premiums that you pay, the way it works, kind of in a way go to fund that, like annuities, similar to annuities. And I'll get into annuities one day. They also pay a big fat commission to the person that sells them. So part of this channel is going to focus on kind of exposing stuff like that. And like I said, I haven't gotten into a whole lot of that, but I'm going to start now that the channel's monetized. I can open up the whole playbook. So if you look at this spreadsheet here, move my face down here to the bottom right a little bit further. So July 2016, $250 per month. This is what's been paid out over time. So we've got 16, 17, 18, 19, 20, 21, and we're into May. So 4 months of payments in the year 2022. So if you take this each year, this would be about $3,000 a year. And then 1,000 this year. So it's 17,500. And the money in your insurance premiums actually goes into an investment. That's why I say it absolutely should be looked at as an investment, because it is. It goes into like a moderately aggressive bucket of mutual funds, which if you've watched my video on mutual funds, you know I'm not the greatest fan of mutual funds. I like index funds, I like ETFs, but I'm not the greatest fan of mutual funds because they really have very high hidden fees and they really rip you off. And I'm going to do another video coming up where I go into very great detail of how exactly, like if you have a financial advisor, how the fees really add up. And a lot of them you may not see or realize. You just may see, oh, my guy's making me money. Well, you may be netting money, but how much are you really paying? So this is part of that, actually. In my plan, I do think life insurance is important, but because this is performed so poorly as an investment, I think that after the 10-year surrender period, because that's what these policies have, you've got to basically keep things tied up for at least 10 years. So in 2026, when this hits the 10-year period, I think that I'm just going to pull it. And hopefully it's at least worth what I put into it. Because if you look net of fees and all that, so here's what happens. So of the $250 premiums, they take off about, starting the first year, $62.50 in fees. This is the table I have over here. I call it fees paid to insurance company / professional management class. And these fees go up every year. Well, this is about an approximation, but it's pretty accurate. And if you see here at the bottom in red, red is an outflow, of course. COI is cost of insurance. And you know, I've never really seen anyone on YouTube go into insurance in depth. So if I'm one of the first ones, that's a good thing. I think it's very valuable. And those of you that follow the CPM metrics, I've heard, I'm going to find out, I guess, but I've heard insurance has one of the highest CPMs in the finance space. So I guess we'll see how well this does. Anyway, so these are the total fees here. So what's happened, the amount left after fees is in this middle table here. So of the $250 payment, there's, starting in year one, $187.50 left. This siphons into the bucket over here, which is underlying investment value, which at the time that I ran this was $14,744.93. So you look at that on the surface, and there's different schools of thought on this. Some people tell you, oh, you can't look at it that way. It's like it would be like your house. Like some people say, oh, you can't look at your primary residence as an investment. Well, I absolutely do. And that's my motto, and I don't care what they say. So the way I look at this, purely from a P&L standpoint, 17,500 minus 14,744.93, right? And you see the difference here, $2,755. And that's basically, so what this is doing, the investment has done poorly, especially it's even worse the last couple months. I actually haven't updated this column, but the investment is doing so poorly, but it's still over a 5-year period. It's ahead of where it would have been if it was like just in cash. So it's offset a little bit of the fees, because you'll notice if there's been almost 5,000 in fees paid and 2755 difference, the investment performance of the underlying bucket has offset some of the fees. Ideally though, at least me, I want this to be worth at least what I've paid into it. But you've got to look at, in a sense, like I said in the example, you know, 450 to 500,000 and a potential payout in the event that this needed to be used. So, and then I did this here, my 4% inflation, hypothetically, which we know we're higher than that, but that's why I factor in 4, because on average it is closer to 4. So if this had been, take cell A17 and then times 6 years of inflation over the duration of this, that's what this would be worth if this cash money just kept up with the rate of inflation. So then I calculated another cell down here, total opportunity cost of holding the policy, which, as you know, if you study economics, opportunity cost is whatever you forego to do something. Like if you watch TV and you don't watch my investment videos, you're foregoing the opportunity cost of making a lot more money by potentially following my edutainment, right? So that's what opportunity cost is. Like when you work, if you're working, you can't be filming YouTube channels. I can relate. So yeah, so I had that at 7,398. I took cell A21 minus cell A18. So that's what I did. I added up, you know, hypothetically, if the 4% rate of return, which matched the hypothetical inflation every year, and then subtracted what it's actually worth. And that's the opportunity cost on that. But I guess you have to focus on the overall death benefit of the policy. So now going over to the middle column here, actual sum invested after cost of insurance. This is the cash value. So this is what the investment has actually performed. And you may jump ahead and see this 19.78% and say, wow, 20%, that's good. No, it's not, because you got to remember that's over 5.5 years. So it's 3.6%, which does not keep up with the rate of inflation. And why is that? Because that is invested in a bucket of mutual funds, which not only do they not outperform their index on average, but the professional fund managers take a big cut off of the top. So that's why you end up with like less than inflation. And I've got these notes here: mutual fund with high fees. We'll probably dump this policy after surrender period is over, which I've already said. So that's the performance of the underlying fund. So at least it's offsetting the cost of insurance overall. But you can look at this on the flip side. You can say, oh, I'm paying, instead of maxing out a 401k, which I do also. But, say somebody looks at this as an alternative to fund like a retirement plan. They would say, oh, $250 a month, that's not bad. That's $3,000 a year versus more money into a 401k. So I guess you could look at it that way. But the problem with these policies is you're beholden to whatever fund family the company that sells the policy offers. So that's really no fun when you're constrained. And the same thing happens in a 401k. With your company that you work for, you're very often constrained to the fund family that your company offers. So there's going to be like a bucket of index funds in that case, like a large cap, small cap, mid cap, S&P 500, so on and so forth. But what's better, like when you can retire, if you retire early, follow the FIRE movement, then you can get that 401k, roll it over to an external brokerage firm, and then you can basically pick any funds you want, which can be even better. You've got the whole ocean instead of just a tiny piece. So, and then the rightmost table here, you can see how the fees go up, because as the older you get, insurance, it's like a table. The older you get, the higher your risk of death is. So that's how life insurance works. So this is where it is now. So the fees have gone up about $10 a month over time. And then the April payment just came out. So that's the total cost of insurance. I think I've gone over everything I had here for you. So policy premiums, actual dollars. So yeah, that's really the gist of it. If you found all that valuable, please remember to like, comment, and subscribe, and keep an eye out for future videos. I have a lot more exciting topics to get into. Like I said, I'm going to get into the full playbook now. So stay tuned and take care.